Welcome back to Boni's Life, where we decode the complex world of global markets and cryptocurrency trading with the precision of a Swiss watch and the excitement of a Formula One race. I'm your host, Boni, and today we're diving deep into what could be one of the most pivotal weekends for crypto markets in 2025. They say timing is everything in trading, but I'd argue that understanding the interconnected web of global politics, economics, and market psychology is what separates the wheat from the chaff. Today, we're going to dissect how current geopolitical tensions, central bank policies, and institutional movements are creating a perfect storm that could either catapult Bitcoin to new heights or send it tumbling toward levels that would make even the most seasoned traders reach for their stress balls. Let's start with the elephant in the room, or should I say, the bear and the eagle circling each other. The ongoing Russia-Ukraine conflict has entered a fascinating new phase, with President Trump's announcement of trilateral talks involving Presidents Putin and Zelensky. Now, before you roll your eyes and think this is just another political theater, let me explain why this matters enormously for your crypto portfolio. Geopolitical uncertainty has historically been both a blessing and a curse for Bitcoin. On one hand, it reinforces Bitcoin's narrative as digital gold, a hedge against traditional financial systems and geopolitical instability. On the other hand, when markets get spooked, everything becomes correlated, and risk assets like crypto often get sold off alongside stocks. The potential breakthrough in Ukraine negotiations could dramatically shift global risk sentiment. If these talks yield positive results, we could see a massive risk-on rally across all asset classes. Think about it. Reduced geopolitical tensions mean lower energy prices, decreased inflation pressures, and potentially more dovish central bank policies. For crypto, this could be the catalyst that breaks Bitcoin out of its current consolidation phase and sends it racing toward new all-time highs. But here's where it gets interesting, and this is where my years of analyzing market psychology come into play. The market has already started pricing in some optimism. We've seen corporate buyers like Metaplanet and Strategy adding over 1,100 Bitcoin during recent dips, signaling that institutional confidence remains robust despite short-term volatility. Now let's talk about the weekend's main event, Jerome Powell's Jackson Hole speech on Friday. This isn't just any speech, folks. This is Powell's swan song as Fed chair, his final Jackson Hole address before his term ends in May 2026. And if you think central bank speeches are boring, you clearly haven't been paying attention to how they move crypto markets. Here's the setup that has every trader on edge. We've got 83.9% of traders betting on a rate cut at the September 17th Fed meeting. That's not just optimism, that's near certainty. But here's the kicker. Inflation has been creeping higher again, with PCE rising to 2.6% in June, while job creation has nearly stalled. Powell is walking a tightrope between acknowledging economic weakness and maintaining credibility on inflation control. For Bitcoin, this creates a fascinating dynamic. Lower interest rates typically make traditional, safe assets less attractive, potentially redirecting capital into higher risk assets like cryptocurrencies. As economist Alex Kruger noted, a more dovish monetary policy could benefit Bitcoin, especially given the current macro environment. But let's dig deeper into the technical implications. Bitcoin is currently trading around $113,800, down from its all-time high of $124,474. The RSI sits at 44, below the neutral 50 level, indicating bearish pressure. We've seen a recent bearish crossover in the MACD, and the 50-day EMA at 115,046 is acting as a critical support level. Here's where Powell's speech becomes crucial. If he signals dovish intentions and validates market expectations for September rate cuts, we could see Bitcoin break above the key resistance at $116,855, potentially triggering a rally toward $119,300 to $120,000. However, if Powell emphasizes inflation risks and delays easing signals, we could see a breakdown below the 50-day EMA opening the door for a test of the $112,000 support level. Let me share something that would have been unthinkable just a few years ago. JP Morgan, yes, the same JP Morgan whose CEO once called Bitcoin a fraud, is now predicting meteoric growth for Ethereum. This isn't just a change of heart, it's a fundamental shift in how traditional finance views cryptocurrency. JP Morgan's analysis focuses on Ethereum's dominance in the stablecoin ecosystem. With approximately $138 billion worth of stablecoins on the Ethereum blockchain, representing 51% of the stablecoin market, Ethereum is positioned to benefit enormously from the stablecoin boom. And speaking of stablecoins, Goldman Sachs just dropped a bombshell report suggesting the stablecoin market could unlock trillions in market potential. Think about this for a moment. Goldman Sachs, the epitome of traditional Wall Street, is talking about a multi-trillion-dollar stablecoin market. They are projecting a 40% compound annual growth rate for compliant stablecoins, with USDC alone potentially adding $77 billion in supply by 2027. Standard Chartered goes even further, forecasting the stablecoin market to reach $750 billion by the end of 2026. This institutional embrace isn't just about price predictions, it's about infrastructure and legitimacy. We're seeing BlackRock, Franklin Templeton, and BNY Mellon tokenizing assets and connecting them to stablecoin rails for faster settlement. The US Genius Act, enacted in July 2025, requires stablecoins to be backed one-to-one with US treasuries, providing the regulatory clarity institutions have been craving. Now, let's get into the nitty-gritty of technical analysis, because charts don't lie even when politicians do. Bitcoin's current technical setup is fascinating, and I mean that in the way a chess grandmaster finds a complex endgame fascinating, not in the way your dentist finds your cavities fascinating. We're looking at a consolidation phase around $113,800, with weekly volumes up 34% to $48 billion, signaling renewed market engagement despite the technical pullback. The long-term trend remains bullish, with the SMA 200 and medium-term SMA 50 both supporting higher prices, but the short-term SMA 20 has neutralized, reflecting what I call smart money fatigue. The key levels to watch are crystal clear. On the upside, we have resistance at the all-time high of $124,533, but more immediately, the $118,145 level represents the upper bound of the value area. A clean break above this level could trigger what I call a bullish imbalance, where buying pressure overwhelms selling, and we see rapid price appreciation. On the downside, support levels are layered like a wedding cake. We have $111,900 as the first major support, followed by $107,400 and $105,200. The monthly pivot point at $114,703 sits just above current prices, serving as a benchmark for the month's trend direction. But here's where it gets really interesting from a derivatives perspective. Open interest is decreasing, indicating reduced speculative positioning, while the funding rate remains high and positive, confirming a bullish bias but potentially hindering new long positions. This creates what I call a coiled spring effect, where reduced leverage could actually lead to more sustainable price movements. Let me paint you a picture of the liquidation landscape, because understanding where leverage positions are clustered is like having X-ray vision in the markets. We have significant selling liquidation zones between $119,750 and $123,050, as well as around $125,000. These levels represent areas where long positions could be forced to close if prices move higher, potentially amplifying any bullish breakout. On the downside, buying liquidation zones are spotted around $111,000, $107,000, and $105,000. These are the levels where short positions would be squeezed, potentially creating flush-type movements if the market breaks these supports. It's like a game of financial Jenga, where pulling the wrong block could bring the whole structure tumbling down, or in this case shooting up. While Bitcoin gets most of the headlines, Ethereum is quietly having its moment. With a 60% rise over the past 6 months, ETH is outperforming Bitcoin, and for good reason. The stablecoin narrative I mentioned earlier is just the tip of the iceberg. Ethereum's network effects are becoming increasingly apparent. Most stablecoins are issued as ERC20 tokens on Ethereum, creating a virtuous cycle where increased stablecoin adoption drives more transaction fees back to ETH holders. It's like owning the toll road that everyone needs to use. And with the stablecoin market potentially reaching trillions of dollars, those tolls could become quite substantial. The technical picture for Ethereum is equally compelling. Trading around $4,289, up 3% in the last 24 hours, ETH is showing resilience even as Bitcoin consolidates. The altcoin season that Coinbase's research team is predicting could see Ethereum leading the charge, especially given its fundamental advantages in the DeFi and stablecoin ecosystems. Alright, let's get practical. You didn't tune in just for my sparkling personality and devastating good looks. You want actionable trading strategies for the next 24 hours and beyond. Here's how I'm approaching this market. First, the range trade. Bitcoin is currently trapped between $111,500 support and $118,000 resistance. This is a classic range-bound market, perfect for swing traders who can buy the dips and sell the rips. But here's the catch. This range is likely to break violently in one direction or the other, especially after Powell's speech. For the breakout traders among you, the levels to watch are clear. A break above $118,200 with volume would confirm that momentum is back in favor of the bulls, with targets at $124,533 and potentially $127,369. Conversely, a break below $111,500 could accelerate selling toward the $105,000 to $100,000 zone. But here's where risk management becomes crucial. Powell's Jackson Hole speech introduces a binary outcome scenario. Either he validates market expectations for dovish policy, sending risk assets soaring, or he emphasizes inflation concerns, potentially triggering a broader risk-off move. In scenarios like this, position sizing becomes more important than being right about direction. My recommendation is to reduce exposure ahead of the speech and be prepared to add to positions based on the market's reaction. If Powell signals September rate cuts and Bitcoin breaks above $118,200, that's your green light to increase long exposure. If he takes a hawkish stance and Bitcoin breaks below $111,500, consider defensive positioning or even short-term hedges. While Bitcoin dominates the headlines, the real opportunity might be in altcoins. Coinbase's research team is calling for a potential altcoin season as we approach September, and the technical setup supports this thesis. Ethereum, BNB, Solana, and Cardano are all showing 4% gains, outperforming Bitcoin's modest recovery. The key to altcoin season is understanding the liquidity flow. Typically, money flows from Bitcoin to large-cap altcoins like Ethereum, then to mid-cap and small-cap tokens. We're seeing early signs of this rotation with Ethereum's outperformance and the strength in DeFi tokens. But remember, altcoin season can be a double-edged sword. While the upside potential is enormous, the downside risk is equally significant. If Bitcoin breaks down, altcoins typically fall harder and faster. It's like being in a speedboat during a storm, exhilarating when the weather is good, terrifying when it's not. Let me put this current situation in historical context, because as Mark Twain allegedly said, history doesn't repeat, but it often rhymes. In April, Bitcoin plunged to $74,587 before rebounding more than $11,000 in just 4 days. The current setup has similar characteristics, with oversold conditions, institutional buying interest, and a major catalyst on the horizon. The key difference is the macro environment. In April, we didn't have the same level of institutional adoption or regulatory clarity that we have today. The approval of Bitcoin and Ethereum ETFs has fundamentally changed the market structure, providing new sources of demand and reducing volatility over time. But perhaps most importantly, we're seeing a maturation in how crypto responds to macro events. The correlation with traditional risk assets remains high, but the recovery patterns are becoming more predictable. Smart money is buying the dips, and retail investors are becoming more sophisticated in their approach. Speaking of regulatory clarity, let's talk about the elephant that's actually helping the room for once. The US Genius Act requiring one-to-one treasury backing for stablecoins isn't just regulatory compliance, it's a stamp of legitimacy that traditional finance has been waiting for. Wyoming Senator Cynthia Lamis has stated that the long-awaited U.S. market structure bill could reach President Trump's desk by year-end, paving the way for implementation in 2026. This isn't just bureaucratic paperwork, it's the foundation for institutional adoption at scale. Think about what this means for the next bull cycle. Instead of fighting regulatory uncertainty, crypto will be operating within a clear framework that encourages institutional participation. It's like the difference between driving on a dirt road in the dark versus cruising on a well-lit highway. Zooming out to the bigger picture, we're witnessing a fundamental shift in the global monetary system. Central banks around the world are grappling with the trilemma of growth, inflation, and financial stability. Traditional monetary policy tools are becoming less effective, and alternative assets like Bitcoin are gaining credibility as portfolio diversifiers. The recent strength in the dollar, driven by tariff policies and relative economic outperformance, creates an interesting dynamic for Bitcoin. Historically, dollar strength has been negative for Bitcoin, but we're seeing signs that this relationship is evolving. As Bitcoin matures as an asset class, its correlation with traditional macro factors is becoming more nuanced. One factor that doesn't get enough attention is China's evolving stance on cryptocurrency. While the official ban remains in place, the practical reality is more complex. Chinese investors continue to participate in crypto markets through various channels, and the government's focus on blockchain technology suggests a more nuanced approach may be emerging. The recent stability in Tether's discount in Chinese markets, as noted by Cointelegraph, suggests that panic selling from Chinese investors isn't a major factor in current market dynamics. This is significant because Chinese selling has historically been a major source of volatility in crypto markets. Beyond the short-term trading opportunities, it's important to remember the fundamental drivers of long-term value in cryptocurrency. The Lightning Network continues to expand, making Bitcoin more practical for everyday transactions. Ethereum's transition to proof of stake has dramatically reduced its energy consumption while maintaining security. The tokenization of real-world assets, championed by institutions like BlackRock and Franklin Templeton, represents a multi-trillion-dollar opportunity. We're not just talking about digital money anymore, we're talking about a complete reimagining of how value is stored, transferred, and traded globally. As we wrap up our analysis, let me emphasize the importance of risk management. The opportunities in crypto are enormous, but so are the risks. The scenario analysis I've presented today ranges from Bitcoin reaching new all-time highs to potentially testing the $100,000 level or lower. The key is position sizing and diversification. Don't put all your eggs in one basket, no matter how shiny that basket might be. Use stop losses, take profits on the way up, and always keep some dry powder for opportunities that arise during market dislocations. Remember, the goal isn't to be right about every trade, it's to be profitable over time. That means cutting losses quickly and letting winners run. Easier said than done when emotions are running high. As we head into this potentially pivotal weekend, the confluence of factors we've discussed creates what I call a perfect storm scenario. Geopolitical developments, central bank policy, institutional adoption, and technical setups are all aligning to create significant potential for market movement. The key levels to watch are clear. $118,200 on the upside for Bitcoin, $111,500 on the downside. Powell's Jackson Hole speech on Friday will likely be the catalyst that determines which direction we break. The institutional embrace of crypto, led by JP Morgan's Ethereum optimism and Goldman Sachs' stablecoin projections, provides a fundamental backdrop for long-term bullishness. But remember, markets are humbling beasts that don't care about our predictions or preferences. Stay flexible, manage your risk, and be prepared for volatility. Whether Bitcoin rockets to new highs or tests lower support levels, there will be opportunities for those who are prepared and disciplined. The crypto market never sleeps, and neither should your vigilance. Keep your eyes on the charts, your finger on the pulse of global events, and your risk management tight. This is Boni, reminding you that in the world of crypto trading, fortune favors the prepared mind. Until next time, trade smart, stay safe, and remember that the best traders are made in bear markets and proven in bull markets. We'll see you in the next episode of Boni's Life, where we'll continue to decode the complex world of global markets with the precision you've come to expect and the insights you need to stay ahead of the curve.